Hello, welcome to this week's Market Carver. I am Andrew Thrasher, Portfolio Manager for Financial Enhancement Group. I'm joined by Zach Unger, Senior Analyst. We have three important topics to talk about this week. We're going to look at kind of the average stock portfolio, as well as specifically how many stocks have been trading actually are positive for the year as we move into the fourth quarter. Then we're going to go back to a very popular topic, looking at the AI space, artificial intelligence, and what's going on there as it relates to the stock market. Then I'm going to turn over to Zach, who's going to give us an update on what's going on in the mortgage space and the sensitivity or lack thereof to interest rates changed by the Federal Reserve. All right, first one we're going to dive into is looking at how stocks have been performing. We've talked throughout this year looking at breadth and the heavy reliance on the Mag 7 stocks, Apple, Nvidia, Microsoft, Google, those types of names. And here we're looking at we're seeing most stocks are performing well. We can see on there's a lot of data here. On the top, we have the S&P 500. Then we have the average year-to-date performance for the stocks that are in the S&P 500. If we look at the far right side, we can see that line is trending higher, meaning we are seeing most stocks are continuing to perform well, all but underperforming the overall market. We can see the same when we start to look at just the S&P 100, the 100 largest stocks, still continuing to move with the market. What is, though, interesting to me when I look at this data is that bottom panel. That's looking at the percent of stocks that are positive for this year. Why this is interesting to me is when we look at where the level we were at going into the correction that we had in the first part of the year, when stocks had that big drop during kind of all the tariff noise in March and April, we were right around 65% of stocks were positive on the year. We had that big pullback, and since then the market's had a really strong recovery, but we haven't seen a breakout of that level. We're still seeing less stocks are positive year to date than the number that was going into that correction. What that tells us is while the market's performing well, and it's not seeing an expansion of stocks continuing to climb out of their large drawdown from the first quarter. In fact, we still have half of all large cap stocks are still down 10% or more. That's a significant drawdown for the fact that we're seeing the S&P 500 continue to make new highs. So while we're bullish, we're positive that we're seeing stocks continually improving in their average performance, we're not quite seeing that expansion, that evolving of more and more stocks become positive year to date, continuing to see that reliance on just a handful of equities. Speaking of those handful of equities, a lot of them are very much tied to artificial intelligence. We're seeing the stock market continue to do really well with a lot of headlines coming out with either ChatGPT making a new partnership or some type of headline relating to AI. In fact, here's a chart here, if we can zoom in on it, that's looking at the number of stocks. This is coming from JP Morgan, looking at the number of stocks that are related in some way to AI. And what we can see here is since we saw ChatGPT launch, the big major AI type platform back in 2022, November of 2022, in fact, here's the performance of those stocks and the percentage of the S&P that they account for. Why this is a little bit concerning is we're almost to 50% of the S&P 500 is reliant on kind of that AI theme. And that's fine when that theme is doing really well, as it has been. It's performed extraordinarily well. But when that theme becomes out of favor, if and when, I guess I should say, we do have a lot of stocks that are heavily tied to it. In fact, like I said, we're almost to 50% of the S&P is reliant on getting performance from these AI type announcements. This is something we saw kind of similar back during the tech wreck, where we saw any company that came out with a website, they just attached .com to their name. We saw a huge explosion in their stock price going higher. The big difference, and this is what we talked a lot about in our allocation meeting on Monday, the differences between today with AI and kind of the bubble forming there and what happened during the late 1990s and the 2000s was those companies really didn't have much of a revenue. If you were trading around that time, as many of you likely were, a popular term that was popularized then was burn rate. It was how much cash do these companies have before they just burn through the reserves and they go bankrupt. That was a very popular term at that time. We're not seeing that today. The companies today like Nvidia, AMD, Apple, Microsoft, they still have enormous revenue growth. So we're seeing a lot healthier companies are driving this AI boom. It's not the same as kind of the wishful thinking of the tech wreck. So that's one positive. The other caveat there is it is starting to get overly reliant. We are seeing a little bit too much focus put on these AI announcements and not yet really seeing the fruit of that labor as far as revenue enhancements, balance sheets showing growth there, margin expansions, really to meet the expectations of what these stock prices are doing. So it's something we're continuing to watch. We recognize this as an environment, not necessarily a signal. Something else we talked about in our allocation meeting on Monday, that we're not saying just because we're almost to 50% that alone means we need to start turning bearish on the market or something troublesome is ahead. It's just recognizing where the market is getting its reliance, where it's getting its performance, and being cognizant of that and watching for any future trend changes in that space. All right, well, that's a look at the equity market. Now I'm going to turn over to Zach, who's going to look at some fixed income stats.
Yeah, so we'll focus specifically here on mortgages and the Federal Reserve, specifically the Federal Reserve cutting interest rates. They cut by a quarter point most recently. They've got a couple more cuts that are expected this year, and then again into 2026. The Fed cutting interest rates has led many people to speculate that we may see mortgage rates come down as a side effect of that. But what we're seeing is that over the past decade or so, the interest rate that is actually most correlated to or most indicative of where mortgage rates are going to go is the U.S. 10-year Treasury bond. As you can see on the screen, they've moved in tandem pretty well over the past 10 years. That trend goes back beyond the data on this chart, and it's pretty sticky. So it's important to understand that the Federal Reserve interest rate, as they start to cut here, is not really influential as to direct where mortgage rates go. There are other factors that influence both the 10-year Treasury and mortgage rates, namely inflation, economic growth, fiscal policy, Fed independence, much longer term issues. As it stands right now, we still have some questions about inflation, particularly around how tariffs play into that, how consumer spending plays into that, and where inflation goes long term. Have some questions about Fed independence, what economic growth looks like. And so you're seeing that priced in the U.S. Treasury market, the interest rate that investors are requiring on those longer term bonds. And you're also seeing that on mortgage bonds as well. So the mortgage bond interest rate is akin to the interest rate that you get on a 30-year mortgage. We're seeing those two move in tandem. And because there's still some uncertainty about where those other long-term factors will end up over the long term, you're seeing higher interest rates. And until we start to get some clarity on where inflation goes long term, if it starts to moderate, if it continues to move upward, or if it just kind of stays stagnant here in this 3 to 4% range, as well as the other factors I mentioned, economic growth, Fed independence, etc. Until we get some clarity on those factors, I would anticipate that what the Federal Reserve does is not going to materially impact where mortgage rates go in the future. Would be beneficial if they started to come down. Typically, that's very has a positive impact for the overall housing market. We know there's some dynamics there that have led to a slower housing market. So if mortgage rates were to come down, that would be beneficial. But we're not expecting that the Fed interest rate cutting is going to provide the boost for that to happen.
All right, thank you, Zach. That's what we have for this week's Market Carver. Look forward to talking with you again next week. If you do have any questions or you'd like to talk with one of our advisors, please use the phone number on your screen, the QR code, or the website there to learn more information. Thank you so much and have a great week.